Good morning, everyone, and welcome. I would like to now call this meeting of the Ncua Board to order. But before I call the first item on our agenda, I would like to acknowledge several groups that are joining us today. If you're in the room, I'd like to maybe have you raise your hands, please. We have the Kentucky Credit Union League. Welcome, welcome, Kentucky Credit Union League. We also have the Cooperative Credit Union Association. Thank you. I'm so glad to see you all. We also have the Cornerstone Credit Union League. Maybe they're waving in the overflow room. And then we have the Credit Union Association of the Dakotas. Good to see you all again. You were all here a few days ago. And then we have the Northwest Credit Union Association. Good morning. My, what a robust delegation that is. And as I mentioned, I also understand that we do have an overflow room. So for those of you joining us in the overflow room, welcome. We are delighted that all of you have joined us today. I must say on behalf of Ncua, you honor us here with your presence. I'd now like to have our first item on the agenda today, which is the Share Insurance Fund Quarterly Report. Staff presenting, Rendell Jones, Chief Financial Officer. Rendell, welcome.
Good morning.
Good morning.
Good morning.
I'm here to present the 2019 second quarter statistics for the Share Insurance Fund. The first table on slide 2 shows the Share Insurance Fund's revenues and expenses for the second quarter of 2019. For the quarter ended June 30th, 2019, the fund recorded net income of $79.1 million. Total income of $81.2 million consists primarily of investment income from Treasury securities of $77.7 million. Additional income sources include $3.4 million collected for guarantee fees on the Ncua guaranteed notes, or NGNs, and about $100,000 of other income is from interest on the building note and insurance exam fees. Operating expenses were $49.8 million for the quarter. The reserve expense decreased by $4.7 million during the quarter. The specific reserve decreased by about $200,000, while the general reserve decreased by $4.5 million. I'll discuss the change in the provision for insurance losses on slide 4. The Natural Person Credit Union Asset Management Estate loss expense shows a reduction of $15.7 million due to favorable changes in the estimated future cash flows of assets held on certain natural person asset management estates. And the corporate AME loss expense decreased $27.3 million due to favorable changes in the estimated future cash flows of the legacy assets in the NGN program. The next table shows the Share Insurance Fund's balance sheet as of June 30th compared to the previous quarter's balance sheet. For the quarter ended June 30th, the Share Insurance Fund's total assets valued at $16.1 billion, of which about 95.5% of assets are funds held with the U.S. Treasury in cash, overnight investments, and Treasury notes. Overall, total assets decreased $112.8 million, or 0.7%, due largely to the dividend paid out in the second quarter, partially offset by collections on the asset management estate receivables. The receivable from natural person credit union asset management estates is $382.4 million, which decreased $43.1 million, primarily due to collection of asset management estate recoveries. The receivable from the corporate asset management estates is $266.9 million, which decreased $32.7 million from the previous quarter. The decrease is due to collections of asset management estate and NGN, or Ncua guaranteed note receipts, offset by continued improvements in the estimated future cash flows in the corporate estates. This receivable is typically reduced by cash collections or recoveries, such as bond maturity sales of assets in the asset management estates and legal recoveries. Accrued interest in other assets is $70.7 million, which decreased $13.7 million, or 15.8%. Total liabilities are $116.2 million, or 0.7% of total assets. Accounts payable and other liabilities of $4.3 million decreased from the prior quarter due to payments made in the second quarter for capital deposit refunds. The board approved $160.1 million of dividends payable to insured credit unions in March. And these dividends were paid to eligible credit unions during the week of May 21st, 2019. The Share Insurance Fund's Insurance and Guarantee Program liability or reserve will be explained in the next slide. And the fund's net position is comprised of capital deposits, which represent the total balance of all federally insured credit unions' 1% capitalization deposit, and cumulative results of operations. Net capital deposit activity increased by about $2.5 million this quarter. The balance of cumulative results of operations increased $226.1 million during the quarter due to unrealized gains on investments of about $147 million and $79.1 million in net income that I described in the previous slide. Next, turning to slide 4, Share Insurance Fund reserves. Share Insurance Fund reserves decreased in the second quarter from $155.2 million to $111.9 million. The reserve expense is $4.7 million, which is comprised of amounts from both the general and specific reserve, and it is a reduction. It decreased $4.5 million for anticipated losses in the general reserve, whereas specific reserves decreased about $200,000 during the quarter. Each quarter, Ncua assesses the specific reserve needs for anticipated credit union failures when the loss is probable and estimable. The Share Insurance Fund paid $38.6 million for the cost of liquidations during the quarter, and the reserves at quarter end totaled $111.9 million, with $5.6 million for specific reserves and $106.3 million for general reserves. Next, the Share Insurance Fund portfolio. As of June 30th, the Share Insurance Fund had $15.1 billion at par value invested in Treasury securities with maturities out to February 2026. The weighted average life of securities held by the Share Insurance Fund is 2 years, and the weighted average yield of securities held by the Share Insurance Fund is 2.03%. Last night, we invested about $2.4 billion in overnights at a rate of 210 basis points, earning approximately $138,000. The second bar chart shows a cumulative picture of how much of the portfolio will mature over time. About 92% of the portfolio will mature over the next 5 years. During the second quarter of 2019, 5 Treasury notes matured in a total amount of about $900 million, and these securities had yields ranging from 0.99% to 2.49%. Turning to the equity ratio chart, the current equity ratio is 1.33%. The ratio is based on an insured share base of about $1.2 trillion at June 30th, 2019. And the blue line represents the normal operating level at 1.38%. The number of Camel Code 4 and 5 credit unions increased by a net of 2 during the second quarter of 2019, for a total of 204. Of these credit unions, 89% have less than 100 million in shares. Approximately 9% have more than 100 million in shares, but less than 500 million, and the remaining 2% have more than 500 million in shares. Total shares represented by credit unions that are Camel Code 4 and 5 are about $9.8 billion, or 0.82% of all insured shares. There was a 9 basis point decrease compared to the ratio at the end of the last quarter. Comparing Camel Code 4 and 5 by asset size from March 2019 to June 2019, total shares decreased about $600 million, or 5.8%, to $9.8 billion, and total assets decreased about $900 million, or 7.6%, to about $11 billion. The number of Camel Code 3 credit unions decreased by a net of 33 during the second quarter of 2019, for a total of 872. Of these credit unions, 88% have less than 100 million in shares. 10% have between 100 million and 500 million in shares, and 2% of these credit unions have more than 500 million in shares. As of June 30th, 2019, total shares in Camel Code 3 credit unions were $44 billion. This is about 600 million or 1.4% increase from last quarter. Camel Code 3 credit unions represent 3.68% of total insured shares at the end of the second quarter of 2019, which is a decrease of 12 basis points from 3.8% at the end of the last quarter. Comparing Camel Code 3 by asset size from March 2019 to June 2019 shows the total number of credit unions decreased in asset size categories for credit unions with less than 100 million and more than 500 million, but less than $1 billion in assets. The total number of credit unions increased in asset size category for credit unions with more than 100 million and less than 500 million in assets, but did not change for credit unions above $1 billion in total assets. Camel Code 3 total shares increased by a net of 600 million or 1.4% in total assets, decreased by about 100 million or 0.2%. On slide 11, this slide shows the distribution of assets by Camel Code, with the red portion of the chart is the percentage of total credit union assets that are Camel Coded 4s and 5s. The green represents the percentage that is Camel Code 3, and the blue represents the percentage of credit unions that are Camel Coded 1 or 2. The distribution of assets over the last quarter increased 0.3% for Camel Code 1 and 2 credit unions, decreased 0.2% for Camel Code 3 credit unions, and decreased 0.1% for Camel Code 4 and 5 credit unions. On slide 12, there were no new credit union failures during the quarter. Through the second quarter of 2019, there was one credit union failure that incurred a loss to the share insurance fund. The failure was an involuntary liquidation with a purchase and assumption agreement. The cost of that failure for 2019 was $40 million. For all of 2018, there were 8 credit union failures, 6 of which were involuntary liquidations with purchase and assumption agreements, 1 regular involuntary liquidation, and 1 assisted merger. The total cost of failures for 2018 was $792.5 million. Fraud was a contributing factor to the 2019 failure that incurred a loss to the share insurance fund. This concludes my presentation. I'll be happy to answer any questions.
Great. Well, Rendell, thank you so much for your presentation this morning. I find that these quarterly updates on the share insurance fund at public meetings of the Ncua board are worth keeping as an agenda item because it keeps both the board and the public informed, and I think that your briefings also foster great transparency, so thank you. Considering you noted the economic activity reflected in the financial statements are consistent with the share insurance fund's expected performance, I do have a couple of questions this morning. If you could please turn to slide 6. The share insurance fund equity ratio. I note that the equity ratio is at 1.33% for the quarter that ended June 30th, 2019, as compared to the fund's normal operating level of 1.38%. Is the reduced equity ratio for June unusual?
It's not unusual based on the cycles in our reporting cycles. So we report the equity ratio twice a year. So as of June 30th, that's based on call report data for June 30th, but we don't invoice based on that information until September with collections in October. And so net invoices for capital deposit adjustments is about $530 million. So that would, once that is reflected, boost the equity ratio back to roughly about 1.38%.
Great, thank you for that clarification. I do just have one final question. And for this one, could we turn please to slide 5? You mentioned to me during our briefing that the staff repositioned the share insurance fund portfolio to provide more overnight funds and investments, especially those maturing in less than 1 year. Do you believe that this policy or this change is still needed?
No, so we still need liquidity, which is already pre-positioned for the sunset of the Ncua Guaranteed Note Program in 2020 and 2021. But the Share Insurance Fund Investment Committee, which is comprised of 4 members, it's me, the Director of the Office of Examination and Insurance, the president of the Central Liquidity Facility and the chief economist, we determined that the amount of overnights is no longer needed. We don't have it for liquidity purposes. So we are repositioning, so you will see term investments for the fund in the near future reflecting what our current liquidity needs are.
Great, thank you. I have no further questions. Board Member Harper.
Thank you, Chairman Hood, and many thanks to you, Rendell, and your team in Ncua for your very good work in managing the Share Insurance Fund. Rendell, your briefing indicates that the Share Insurance Fund is in a strong position at this time, but I do have a few questions about the investment management, building off of Chairman Hood's questions as we go forward into the future. Looking at slide 5, the Share Insurance Fund portfolio. The portfolio's weighted average life is 2 years, and the weighted average yield is 2.03%. When I speak with credit unions, I often raise concerns about liquidity risk, especially as their loans to share ratios rise. My concerns are that unless properly managed, credit union assets may be tied up in higher paying, longer term assets that may be difficult to liquidate when cash is needed. Should the Share Insurance Fund also be more concerned about chasing yield to increase income?
So the fund's investment objectives are threefold in priority order. The first being safety, in that we invest in Treasury securities, obviously backed by the full faith and credit of the U.S. government. The second is liquidity. So the investments are typically tiered to yield the liquidity we believe for the operations of the fund. And then the third is yield. And so yield, of course, is important, but secondary to the other two investment objectives.
Right. Given the current economic performance, anticipated short-term expenses, historical performance, and other factors, would it be prudent to extend the weighted average life of the Share Insurance Fund at this time?
So we believe, based on what our current liquidity needs are, that you will see increased term investments in the weighted average yield inch up a bit, and we think that's consistent with the operations of the fund.
So we've begun implementing that now?
Yes.
And we're going to be doing that for the immediate future?
Yes.
So we can expect to see some of these bars change as we go along?
You will see it smooth out a little bit based on our annual liquidity forecasted needs.
Thank you for that, Rendell. Let's turn to slide 3, the Share Insurance Fund balance sheet summary. When I add the two net positions together, that totals nearly $16 billion. Is it true that credit unions have a claim on the larger number, the $11.4 billion that is on their books, and the remainder, nearly $4.6 billion, is in the Share Insurance Fund and solely by the Share Insurance Fund?
That is correct.
Okay, and how does this differ from the Deposit Insurance Fund managed by the FDIC?
So the Deposit Insurance Fund is financed by premiums, and those are expensed by insured banks when they're submitted to the FDIC, as opposed to capital deposits, obviously remain assets of both the Share Insurance Fund and credit unions.
And when those deposits, or I should say, the premiums are paid into the FDIC, those are contained in the Deposit Insurance Fund?
Yes.
Okay, thank you. And finally, I'd like to go to slide 17, which is in the appendix to today's presentation. I know it's a little hard to see with the screen there right now, but as I looked at the paper, it looks like that only 4% of the system's assets are in Camel Code 3, 4, and 5 credit unions. That's the lowest level in more than a dozen years. Can you tell me if it's the lowest level that we've seen since we began tracking this information?
So it's certainly the lowest in the information that I've seen recently. I'm not gone back and looked at since we've been tracking it, but it is a very long time, which reflects a good position for the industry.
Great. Thank you for your answers today and for your hard work. I have no further questions.
Thank you. Board Member McWaters.
Thank you, Mr. Chairman, and thank you, Rendell, for your work on this. Let's go to slide 2. My usual question, I ask this. This is probably my 20th or 21st briefing, so I probably ask this question every time. And you would think by now I would understand it, okay? But just in case someone is new in the audience and doesn't, this may be helpful. Under slide 2, where it says loss expenses, Mpcu, AME, loss expense, it says reduction, and the one below says reduction. Why do we have reductions of expenses as opposed to increases in expenses? I mean, it sounds like a good thing, but
it is.
Why is that?
Essentially, it's reversing bad debt expense where previously we've incurred it based on actual losses or estimated losses, and then sometimes those estimates, which are obviously point-in-time estimates, turn out to need to be adjusted as we would do every quarter. So they are good. They boost net income, but it's essentially reversing bad debt expense.
Okay, so when we estimate something, we tend to estimate a little on the conservative side. It turns out better than that conservative estimate, so we have to reverse it.
That's correct. And the activity at the Asset Management and Assistance Center, AMAC, on assets that they have under management for liquidated credit unions, sometimes we do better than we forecast initially upon the failure of a credit union. And so if we are able to generate more income, that could reverse those bad debt expenses that we initially incurred when the credit union failed.
Okay. Slide 3. Under assets, it says receivable from Mpcu Asset Management Estates net. This $382 million receivable, is that in effect saying that if nothing is collected on the receivable, the maximum amount of additional loss would be $382 million?
Yes.
Okay. Okay. Thank you. Slide 5. Weighted average life of 2 years, weighted average yield 2.03. As I recall, when I first saw this slide a few years ago, the weighted average life was around 5 years. And we took it down to this number because of enhanced liquidity needs. So is it not true that we are prohibited from in any way trying to time the markets here with respect to interest rate movements?
Absolutely.
Absolutely. We're prohibited from doing that. We are prohibited, just correct me if I'm wrong, prohibited from chasing yield here.
We are prohibited. Treasury's guidance is very clear to federal agencies that invest with them that they are not allowed to do that.
Okay, so this decrease is not chasing yield. It's simply saying we needed liquidity, but now we're sort of reversing and saying it looks like in the crystal ball, the best we can come up with, less liquidity is going to be needed so we can expand over time this weighted average life.
That's correct.
Okay, thank you. And on slide 6, this goes to what the chair asked on the 1.33 equity ratio and the normal operating level of 1.38. So this is nothing more than a timing difference. This is something we would expect
It's what we would
year in,
expect.
year out, okay? Just because of the timing difference of when we bill for these deposits, when we collect them, that's simply not this time. It's not reflected in this. It'll be reflected in the next, I guess, quarter, right?
The next quarter's report,
Okay.
we would reflect the capital deposits that were invoiced in
Okay.
this month.
Okay, so just a timing difference. And that's all I have. Thank you very much.
Okay, thank you again, Rendell.
Thank you.
The second item on our agenda today is Final Rule Part 715, Supervisory Committee Audits. Staff presenting, Ian Marina, Associate General Counsel, Marvin Shaw, Staff Attorney, Office of General Counsel, and Scott Neat, Associate Director, Office of Examination and Insurance. Welcome, gentlemen.
Good morning. Good morning. Good morning. We're here today to present the final rule submitted to Part 715 of NCUA's regulations about the responsibilities of a credit union supervisory committee to obtain an annual audit of the credit union. These requirements are based on the charter size type and asset size. We have a diagram up there on the screen. The final rule implements recommendations outlined in the agency's Regulatory Reform Task Force. This rule can be characterized as one that simplifies the regulations, provides additional flexibility to credit unions, and reduces regulatory burden. The board approved the proposed rule in February 2019. We received 22 comments. The commenters were from credit unions and accountants at audit credit unions. Commenters were largely supportive of the proposed changes. Some commenters made recommendations to improve the rule, and we've incorporated many of those changes. Scott will briefly highlight the details of the amendments made to Part 715. After that, we'll be happy to respond to any questions.
Thank you, Marvin. As Marvin mentioned, this rule is about simplifying compliance and providing additional flexibility to credit unions. To that end, the final rule includes 4 changes to the current Part 715. First, the current rule offers the credit union, which is not required to obtain a financial statement audit, alternative options to fill its supervisory committee responsibilities. One of those options is to conduct an agreed-upon procedures audit as outlined in the supervisory committee guide. Unfortunately, the guide is 350 pages long, overly specific, and we believe is outdated. The revised rule replaces the guide with an appendix to the rule that distills the guide down to a manageable, targeted list of minimum areas that must be included in the supervisory committee audit. The new appendix included in the revised rule reflects common industry practices for testing accounts and controls. This streamlined appendix will greatly clarify and simplify the audit process and provide significant regulatory relief. Second, another option the credit union currently has to fill its annual audit requirement, if not required to obtain a financial statement audit, is to obtain a report on examination of internal controls over call reporting. As of June 30, 2019, only a handful, that's less than 35 credit unions, use this option to satisfy their audit requirement. Furthermore, we believe this option has limited value in serving as an audit of the credit union's financial reports and conditions, as it does not necessarily involve any review of balances reported. Accordingly, the revised rule eliminates this option. Third, the revised rule eliminates the balance sheet audit option, which again provides less useful information than the other audit practices and was again only used by a limited number of credit unions. Fourth, the current regulation requires the credit union to obtain an engagement letter from an outside compensated party if they are assisting the credit union with their audit. This engagement letter must include a strict 120-day time frame for delivery of the written report. The revised rule eliminates this 120-day time frame and allows the credit union the flexibility to negotiate the target delivery date free of a specific time requirement as long as the agreed-upon delivery enables the credit union to meet its annual audit requirement. That concludes our prepared remarks. We'd be happy to answer any questions you may have.
Well, thank you all again for all your hard work on this rule, and I know that there are more than the 3 of you who worked on it, so let's thank all of those who put effort into it. This final rule addressing supervisory committee audit requirements is an example, I believe, of the NCUA's diligent and ongoing approach to updating regulations and prudently reducing that burden. The final rule provides credit unions additional flexibility regarding the time frame for the auditor to deliver the audit report. While this is indeed modest regulatory relief, it demonstrates the agency is looking closely at unnecessary or unduly burdensome regulations from various angles. I would note that many credit unions and other organizations have their year-end financial statements audited. Combined with tax season, the first 4 months of the year can be a busy time of the year for CPA firms. The flexibility this rule provides for the delivery of the audit report can make it easier for credit unions to work with their preferred CPA firms. This final rule also modernizes the regulations by incorporating audit requirements into the regulations instead of referencing a separate manual, and by removing 2 seldom used types of reviews that have limited utility. With that in mind, I do have a few questions. First, I understand this final rule will decommission the supervisory committee guide. Does this mean that the credit unions will only have a new appendix for guidance on the minimum areas for an audit?
While we will be decommissioning the supervisory committee guide, we're still going to have it on our website as reference material. We're going to clearly notate that it's for reference material only, and we won't be updating it. We're also going to be providing some additional guidance to supplement this new rule. That prior to this rule becoming effective, we're going to provide additional guidance to supervisory committees regarding the audit scope that they can use for their audit.
Great, thank you. And I do have another question, and that's regarding the balance sheet audit option. Can you explain why removing this won't take away from a supervisory committee's useful audit option? It almost sounds counterintuitive.
Well, I agree it does take away an option, but I think the key term there is useful. Because the balance sheet audit does not involve an audit of the income and expenses, we feel that that's an important part of what an audit should encompass. And when you're evaluating the equity accounts, it's key that the income and expenses be reviewed. And as I mentioned earlier, there are very few credit unions that use that audit option.
Great, thank you. And I do have a final one. In fact, I'm sorry, but I did want to mention something from our commenters. In fact, some of the commenters noted that not all state chartered credit unions are indeed required to have a supervisory committee or audit committee. Can you explain how we address this in the final rule so it's included in the record?
I'd be happy to address that question. We reviewed those comments carefully, and if I could draw your attention to the final rule preamble, around page 18 we have a detailed discussion of that issue to clarify that for those state chartered credit unions that may not have a supervisory committee or audit committee, the credit union's board of directors would have that responsibility. So we tried to be very explicit in the final rule preamble to clarify how the NCUA board carries out that mandate with respect to all federally insured credit unions.
Great. Again, thanks for all your hard work. I have no further questions. Board Member Harper.
Thank you, Chairman Hood, and thank you, Marvin, Scott, and Ian, for your presentation today. I very much appreciate your hard work on these matters. In my view, this proposed final rule manages to thread the needle by simultaneously streamlining and strengthening the Supervisory Committee audit. That is a good thing in my view. Before I vote in favor of this rule, however, I did have a few brief questions. First, how will the changes we are making here today sufficiently protect the Share Insurance Fund from losses?
Our analysis has shown that it would have very little impact on the losses to the Share Insurance Fund. There's still going to be a requirement that the credit unions have an annual audit. It's just that we're not mandated that audit report to be delivered in 120 days.
Okay. Second, I want to build off a question that the chairman asked about. We note that the NCUA may issue guidance and reference materials to facilitate implementation of the rules, such as audit scope. What might the topics be in such guidance and reference materials?
The appendix that's included in the proposed change, the rule, includes all the areas that we expect to see in the audit by topic area, for instance, like reviewing loans, investments, that type of thing. But it's not very prescriptive at all regarding exactly what would be entailed in the audit scope. This audit tool that we're going to be providing provides recommendations to the supervisory committee they can use as when they're preparing the audit scope for their outside auditor, provide more specifics for that. But at the end of the day, it's still up to the supervisory committee to determine exactly what that scope would be. They also have flexibility to expand upon the areas that are included even in the reg to look at additional areas. But we felt it was important that we provide them some sort of guidance if they felt they needed it to help them with their scope.
That's very helpful information, Scott. When should we expect credit unions to get such guidance and reference materials from us? And specifically, will they get it before the implementation date?
Yes, they will. We'll have that on our website within 90 days prior to the finalization or the implementation of this rule. We already have a draft. We've been working with the AFCPA and several CPA firms on these audit procedures, and we're very close to having that completed.
Thank you, Scott. Finally, my last question. In the proposed rule, we initially sought comment on whether to include testing for Bank Secrecy Act and anti-money laundering compliance as part of the appendix. But this final rule dropped the proposed change because it was redundant of our other rules. What are those rules and what do they require?
Our Part 748 covers BSA and AML, and it provides extensive requirements both for the credit unions to establish procedures to comply with Treasury regulations and FinCEN, and then we have our safety and soundness examiners look for that and examine that. So these are the experts in that area. So we view it as a better approach than adding this requirement in the audit.
Thank you for that answer, Marvin. Mr. Chairman, I will support this rule and yield back.
Thank you. Board Member McWaters.
Thank you, Mr. Chair, and thank you, gentlemen, and to your colleagues for your work. This is regulatory relief. It's not dramatic regulatory relief, but if you're the person in the credit union that has to do this, this is a big deal. So I will support it, and I have no additional questions. Thank you.
Great. Thank you. Is there a motion?
Yes, there is. I move that the board approve final rule part 715 of NCUA's rules and regulations as attached to the board action memorandum.
Is there a second to the motion?
Second.
There is a sufficient second. All in favor say aye. All
Aye.
opposed
Aye.
say nay. Aye. The ayes have it, and let the record show the motion passed 3-0. Thank you, gentlemen.
Thank you.
Ian, I think you get to stay with us.
I do. I hope I don't overstay my welcome.
Well, we'll start charging momentarily.
That seems fair.
The third item on our agenda today is Final Rule Part 701, Appendix A, Federal Credit Union Bylaws. Staff presenting, Ian Marina, Associate General Counsel, Rachel Ackerman, Senior Staff Attorney, Office of General Counsel.
All right, well, thank you. We are presenting the final rule on the Federal Credit Union Bylaws. As way of background, the Federal Credit Union Act directs the NCUA Board from time to time to prepare a form of the Federal Credit Union Bylaws. And consistent with that, we are presenting this final rule to update the bylaws. We're very pleased to be presenting this final rule. This represents an extensive collaborative effort with credit union industry stakeholders. Starting in 2013, the Office of General Counsel consulted with credit union industry stakeholders to identify areas for potential changes and improvements to the Federal Credit Union Bylaws. In early 2018, the NCUA Board issued an advance notice of proposed rulemaking to formally solicit comments on potential areas of change. This included procedural issues such as the NCUA's process for handling bylaw amendment requests, as well as many substantive areas which Rachel will address when she details the final rule. Building upon the input from the advance notice, the Board issued a notice of proposed rulemaking in October 2018, which proposed numerous changes throughout the bylaws to update and clarify the document to provide greater flexibility to federal credit unions while maintaining important member rights. At the same time, the proposed rule codified many previous OGC legal opinion letters to incorporate them in one document for ease of use and reference and clarity for federal credit unions. We received 35 comment letters on the proposed rule, which provided significant, substantial input, which we've reviewed carefully, and where feasible and appropriate have incorporated into the final rule. One final note that I would draw your attention to is that if the Board approves this final rule, it would become effective 90 days upon publication in the Federal Register, which would bring us roughly to the end of this calendar year. And with that, Rachel will now detail the key features of the final rule.
Thank you, Ian. The first material change codifies the NCUA practice of having the Office of Cure review bylaw amendment requests. The final rule provides Cure 60 days to act on amendment requests. If a decision is not reached within 60 days, it is deemed denied. However, Cure may ask for an extension. A federal credit union may appeal the denial to the Board, and Cure has 30 days from any automatic denial to provide the federal credit union with a list of any concerns. This is a change from the proposed rule. The proposed rule provided for a 90-day period to decide on a bylaw amendment and did not require Cure to provide any subsequent information on a credit union to a credit union if that time period had lapsed. The final rule also codifies and clarifies federal credit unions' ability to enact limitation of service policies. The final rule clarifies a federal credit union's right to limit services or access to facilities if a member is not in good standing. For example, a federal credit union may limit services to disruptive or abusive members. A federal credit union, however, may not restrict access to services, or it may not restrict access to a share account or attendance in an annual and special meeting on this basis. I want to highlight that this fact does not limit a federal credit union's ability to take immediate action if a member poses a risk of harm to the federal credit union, its members, or staff. A federal credit union always may take immediate action, such as contacting local law enforcement to protect its members and staff. The final rule also makes several changes to the requirements for meeting of members. Under the proposed rule, quorum constituted 12 members, excluding board members and staff, instead of any 15 members as under the current rule. This was not adopted in the final rule. Under the final rule, any 15 members will constitute quorum. The final rule also makes a change related to hybrid annual or special meetings. Hybrid meetings are meetings held in person and virtually. Under the proposed rule, federal credit unions had to apply to the NCUA to conduct hybrid meetings. After reconsideration, under the final rule, all federal credit unions conduct hybrid meetings without specific approval from the Board. However, only federal credit unions with appropriate infrastructure and capabilities should conduct hybrid meetings. The final rule also provides specific guidance to federal credit unions interested in establishing Director Emeritus and Associate Director positions. These changes provide credit unions greater flexibility and enable federal credit unions to better plan for vacancies and board positions and retirements among current directors. The final rule also requires the Federal Credit Union's nominating committee to widely publicize the call for nominations to members and interview members that meet criteria established by the nominating committee. This provision should provide more opportunities for board participation from all credit union members. Finally, the final rule clarifies how a federal credit union can expel a member. Under the Federal Credit Union Act, a federal credit union may only expel a member at a special meeting or by operation of a non-participation policy. These are statutory requirements. The final rule clarifies that expulsion and withdrawal are statutory, and a federal credit union cannot expel a member for abusive conduct under non-participation policy. But, as stated previously, the federal credit union may limit services or access to its facilities if a member is disruptive, abusive, or violent, and a federal credit union can always contact local law enforcement if necessary. I'm now happy to answer any questions you may have.
Great. Thank you all for your presentation. This final rule, as you've noted, is the culmination of a long process and reflects many years of meaningful dialogue between the NCUA and credit unions. The final rule before us reflects many of the comments the NCUA received throughout the rulemaking process and modernizes bylaws of federal credit unions. I believe the final rule will provide a benefit across the credit union industry by improving a federal credit union's ability to manage routine day-to-day matters related to its operations and governance. I'd like to highlight a few provisions of the final rule. First, the proposed rule clarifies federal credit unions' right to limit services or restrict access to credit union facilities to disruptive or violent members. Since this has been raised, let me be absolutely clear this morning. Without reservation, certain actions warrant an immediate response to protect the security of credit union staff, property, and other guests. A credit union should indeed take immediate action such as contacting local law enforcement, seeking a restraining order, or pursuing other lawful means to protect the credit union, its members, and staff if necessary. Nothing in the Federal Credit Union Act or the bylaws prevent federal credit unions from using whatever lawful means it deems necessary to address circumstances when anyone, regardless if the person is a member of the credit union or not, poses a risk of harm. I also want to note a provision in the final rule that permits federal credit unions to have hybrid annual and special meetings. I particularly think this change would be helpful to federal credit unions whose field of membership includes members of the armed services and their families. Since active duty military personnel are serving our country throughout the world, it isn't generally practical for these federal credit union members to participate. I'm glad that this rule gives credit unions the flexibility to consider other options to allow these active duty members to participate. Finally, I also want to highlight a provision in the final rule that aids succession planning efforts. The final rule clarifies that federal credit unions may establish associate director positions. Associate director positions provide individuals with an opportunity to gain exposure to board meetings and discussions, but without former director responsibility, and is a great way to increase the pool of potential board members, something that is critical, especially at small credit unions. And in fact, I'd like to call attention to the New Mexico delegation, because when I met with them earlier this week, I was made aware then of a credit union there in New Mexico that does have the associate board members. And you all knew the excitement that I expressed about this and how it does build a pipeline for the future of our industry. Now I do have a few questions. Federal credit unions must submit proposed bylaws to the NCUA for approval as part of the chartering process for new credit unions and must operate according to its approved bylaws. Do existing federal credit unions have any obligation under the final rule before us today?
No, existing federal credit unions, they don't need to take any action under the final rule. They're encouraged to under the bylaws, but they're not required to, as opposed to newly chartered credit unions that would be required to use the bylaws in the final rule.
Great, thanks. And if a federal credit union chooses to update its bylaws in response to the final rule, must the organization adopt all of the provisions included in the final rule?
No, they could adopt it piecemeal depending on which options work best for that particular credit union. The rule provides that flexibility.
Great, thanks. And then one final question. During a recent business meeting in Chicago, I was able to visit with some of the local credit unions, and it was there that one of the credit union representatives from one of the smaller institutions mentioned concerns about bylaws. The credit union was concerned about unnecessary paperwork requirements and postage expenses. In particular, this credit union believed the notice for events such as annual and special meetings and elections must each be a separate mailing, something that increases the cost of postage, something that especially matters for some of our smaller credit unions. For smaller credit unions, this can be often an excessive regulation, not an effective one. And it goes back to what Mr. McWaters was saying earlier about some of the small steps are really important for some of the smaller institutions. Can these notices be combined with regular communications from credit union to members? For example, could a credit union send the notice regarding the nomination process and monthly or quarterly statements in the same mailing?
Yes, the notices under the bylaws don't have to be in a separate mailing. A credit union can combine the notices required under the bylaws with any ordinarily mailings they're doing to their members. However, the bylaws do have special timing requirements. The credit union couldn't violate the timings in the bylaws in order to combine two mailings. But yes, a credit union could provide, for example, the notice in the annual meeting with a quarterly statement. That's permissible.
Great, thank you. And I have no further questions. Board Member Harper.
Thank you, Chairman Hood, and thank you, Rachel and Ian, for your presentation today and for your diligence in working on this important rulemaking. In short, I concur with the staff recommendations that a standard set of bylaws drafted by the NCUA protects fundamental member rights, avoids confusion among federal credit unions, and prevents the adoption of illegal bylaw provisions. In adopting these long overdue bylaw changes today, we will make good public policy with the enhanced notice requirements to widely announce annual and special meetings and encouraging the webcasting of these proceedings. I'm also very supportive of the provisions in this final rule that permit hybrid, in-person, and virtual meetings in certain circumstances, and I should congratulate Mr. McWaters on his efforts to make some changes on this provision. I think that they were very good in that regard. This final rule will also better publicize the nominations process and encourage federal credit unions to form boards that reflect their fields of membership. With respect to this last change, I am pleased that we modified the preamble to include a discussion about considering board diversity as part of the nominations process. Diversity and inclusion is a good investment. It leads to better service, increased membership, and improved financial performance. In that regard, and with so many people in the room today, I do want to highlight the NCUA's voluntary diversity self-assessment tool. This tool is available at cudiversity.ncua.gov. Let me repeat that. It's available at cudiversity.ncua.gov. I encourage all credit unions to use the tool to measure their performance and commitment to diversity. Before I close my remarks, I do have two questions for staff. In option 2 for section 3 of Article 8, that's quite a mouthful, we require that if a credit union uses an automated lending system, the loan officer must review all loan applications the system has denied and review at least a sample of approved loans to screen for fraud and ensure that the automated system is functioning within the lending policies set by the board. We know that automated systems sometimes can produce unintended consequences, especially if there is some form of unconscious bias built into the system. My first question, therefore, is whether that loan officer review also includes compliance with consumer financial protection laws, including anti-discrimination, fair lending, and fair housing laws.
Yes, it does. The lending policies established by the board must be compliant with fair lending and anti-discrimination laws. And the bylaws require that the credit committee or the loan officer review the automated lending system with compliance with established lending policies. So that does require that the credit committee or the loan officer review the lending policies for applicability to all laws, including anti-discrimination and consumer compliance laws.
I appreciate that answer, Rachel. And on a second question and my final question, I want to reiterate a point that the chairman made. Once the board finalizes these changes, will all federal credit unions need to make changes to their bylaws, or can they keep their current set of bylaws in place?
No, they won't need to make any specific changes, and they can keep their current bylaws in place if that's what they want to do.
Thank you again, Rachel and Ian, for your efforts. I will vote yes on this proposed final rule.
Thank you. Board Member McWaters.
Thank you. I practiced corporate law for a long time, and bylaws are the foundation of good corporate governance. They're very mechanical, they're very process-oriented, but they're key. It's particularly important that they're updated. There's been so many changes in technology. It wasn't that long ago, it was an odd thing to have a teleconference board meeting. Now it's video, now it's over the internet, and the like. Why? Because it works. It works. People can hear one another, they can see one another, they can talk. Presentations from council and the like can be showed on a screen. So it's really the functional equivalent of being there live. And so it's important that the NCUA has moved into the 21st century here. I would say that we have vested some authority on bylaw review with CURE, and we've set certain deadlines. I would encourage CURE to conduct the reviews of bylaws changes as expeditiously as possible. You know, particularly if someone presents from a credit union a redline version of the bylaw changes, you know, it seems to me that's something more likely than not that can be ticked off in a morning or an afternoon at the most, and not over the 2-month review period that we permitted, or 2-month plus review period. I think it helps support the credit union community for those within NCUA to be as prompt as possible with safety and soundness concerns being paramount to the request, reasonable requests made by the credit union community. And I will emphasize what the chair said, and Board Member Harper, use common sense on some of this stuff. What the Federal Credit Union Act says is that you cannot expel a member from being a member without jumping through some very tough ropes. That rule is clearly out of date. It was at a time when credit unions all met around a table, and if you didn't like what Bob or Mary was doing, it was easy to get rid of them because everyone around the table could basically vote them out. That's no longer the case. So if they're causing trouble, and I've heard these things reported to me about people coming into the credit union lobbies and assaulting people, and occasionally with a battery, call the police, call the cops, just like you would do if it was a stranger on the street. Don't tolerate that. You're making a mistake, and you may be subjecting yourself to legal liability. Just saying. I don't have any specific questions. I welcome Board Member Harper's inclusions on diversity and inclusion. Absolutely. On fair lending, absolutely. Compliance with all laws, absolutely. Thank you very much.
Thank you. Is there a motion?
Yes, I move that the board approve Final Rule Part 701, Appendix A of NCUA's Rules and Regulations as attached to the board action memorandum.
Is there a second to the motion?
Second.
There is a sufficient second. All in favor say aye.
Aye.
All opposed say nay. The ayes have it, and let the record show the motion passed 3-0. Again, thank you, Ian and Rachel.
Thank you.
The final item on our agenda today is Final Rule Part 701, Payday Alternative Loans Part 2. Staff presenting, Matt Belores, Director, Office of Consumer Financial Protection, Joseph Goldberg, Director, Division of Consumer Compliance Policy and Outreach, and Frank Pressman, Deputy General Counsel. Welcome, gentlemen.
Thank you. Good morning, Chairman Hood, Board Member McWaters, and Board Member Harper. Frank, Joe, and I are pleased to present for your consideration a final rule to amend our current Payday Alternative Loan, or PALS rule. The proposed rule, which was approved by the NCUA Board at its May 2018 meeting, was designed to provide federal credit unions with an additional option to offer payday alternative loans. It is not intended to replace the current PALS rule. Rather, it will be an alternative option with different terms and conditions for federal credit unions to offer PALS to their members. the PALS 2 rule proposed to incorporate many of the structural features of the current PALS rule designed to protect borrowers from predatory payday lending practices. Those features include, among others, a limitation on rollovers, a requirement that each PALS 2 loan fully amortize over the life of the loan, and a limitation on the permissible fees that a federal credit union may charge a borrower related to a PALS 2 loan. A federal credit union would also have to structure each loan as closed-end consumer credit. Proposed new or modified features unique to PALS 2 loans included areas such as loan amount, loan term, membership requirement, number of loans, and a restriction on overdraft fees. The 2018 proposal also requested comment on a series of questions to contemplate an even more flexible PALS 3 loan product. We received 54 comments on the PALS 2 proposal from credit unions, various trade organizations, state credit union leagues, consumer advocacy groups, state and local governments, and a few individuals. A majority of the commenters supported the board's proposed PALS 2 framework, but sought additional changes to provide federal credit unions with more regulatory flexibility. Some commenters, however, strongly opposed the proposed PALS 2 framework. These commenters argued that the proposed framework would blur the distinction between PALS and predatory payday loans, which could lead to greater consumer harm. Instead, these commenters urged the board to focus on methods to curtail potential predatory lending by credit unions outside of the original PALS rule and to address potential abuses regarding overdraft fees. After thoughtful consideration of all the comments received, we are recommending the board move forward and adopt certain aspects of proposed PALS 2. While we continue to evaluate comments specific to a potential PALS 3 product, we are not recommending any action at this time regarding that loan program. I'll spend the remainder of our presentation discussing our recommendations for PALS 2. The first item I'll discuss relates to the length of member requirement. The current PALS rule requires a borrower to be a member of a federal credit union for at least 1 month before the credit union can make a PALS loan to that borrower. The PALS 2 proposal removed this minimum membership time requirement for PALS 2 loans. The purpose of this change was to allow a federal credit union to make a PALS 2 loan to any member borrower that needs access to funds immediately and would otherwise turn to a traditional payday lender to meet that need. The majority of commenters that addressed this issue favored removing the minimum membership time requirement. These commenters argued that this change would provide maximum flexibility to serve borrowers that need immediate access to temporary liquidity. In contrast, a few commenters argued against this change, noting that a minimum membership requirement is a prudent lending practice that helps a federal credit union establish a meaningful relationship with a potential borrower before offering a PALS 2 loan to that borrower. In our view, granting PALS 2 loans to member borrowers who need immediate access to funds seems to be a better alternative than having these borrowers take out traditional payday loans and wait for 30 days before refinancing that much higher cost payday loan into a PALS 2 loan, or worse, never applying for a loan from a credit union. I should point out that nothing in the final rule prohibits a federal credit union from establishing a length of membership time requirement for their PALS 2 loans if they choose to do so. Therefore, we are recommending the board adopt this aspect of the PALS 2 rule as proposed. Next, I'll address minimum loan amounts. The PALS 2 rule proposed to eliminate the current PALS minimum loan amount of $200. Several commenters expressed support for removing the minimum loan amount as a means of allowing a federal credit union to tailor its PALS 2 program to the unique needs of its members. In contrast, other commenters argued that removing the minimum loan amount would result in an effective triple-digit APR comparable to a traditional payday loan for any PALS 2 loan under $200, where the credit union also charges an application fee. Some argue that it may not be prudent for a federal credit union to require a member to borrow more than necessary to meet their demands for funds. Establishing a minimum PALS 2 loan amount could require a borrower to carry a larger balance than necessary and incur additional interest charges when a smaller PALS 2 loan would satisfy that borrower's need for funds without the additional interest charges. If a member does not want to borrow more than they need, a minimum loan amount could result in the member obtaining a smaller loan at a traditional payday lender at a much higher cost and with less consumer protections. On balance, the borrower's desire to avoid additional interest charges seems to outweigh the need to avoid the appearance of a higher APR for smaller PALS 2 loans. Therefore, we recommend the board adopt this aspect of the PALS 2 rule as proposed. Moving on, I'll touch on the PALS 2 upper dollar limit. The PALS 2 rule also proposed to allow a federal credit union to make a PALS 2 loan for up to $2,000. By way of contrast, the current PALS rule currently limits loan amounts to a maximum of $1,000. Allowing a higher loan amount would give a federal credit union the opportunity to meet demand for higher loan amounts from payday loan or auto title borrowers and provide some borrowers with an opportunity to consolidate multiple payday or auto title loans into one PALS 2 loan, a means that creates a pathway to mainstream financial products and services offered by credit unions. Many commenters argued against the $2,000 maximum loan amount as too low and suggested an upper limit as high as $4,000. These commenters argued that $2,000 is insufficient to cover most large financial emergencies that prompt a borrower to resort to a payday loan or to allow a borrower to consolidate all of the borrower's payday loans. Some of these commenters, however, also argued that a larger maximum loan amount would be more profitable and allow a federal credit union to make sufficient interest to cover the cost of this type of lending. In contrast, some commenters argued that allowing a credit union to charge a 28% interest rate for a $2,000 PALS 2 loan is a slippery slope to allowing a credit union to operate outside of the usury ceiling. These commenters noted that larger, longer-term loans provide increased revenue to the credit union, and therefore the board should not adopt a special exemption from the general usury ceiling for these types of products. We think a maximum loan amount of $2,000 strikes an appropriate balance to allow members to address larger emergency funding needs or to consolidate higher-cost payday or auto title loans. We therefore recommend the board adopt this aspect of the PALS 2 rule as proposed. I'll now shift focus to the maturity limit. The current PALS rule limits loan maturities to a minimum of 1 month and a maximum of 6 months. The PALS 2 proposal allows a federal credit union to make a PALS 2 loan with a minimum maturity of 1 month and a maximum maturity of 12 months. The longer PALS 2 loan term will allow a federal credit union to establish a repayment schedule that is more affordable for the borrower while still fully amortizing the loan. All of the commenters addressed this issue favored a maximum loan term of at least 1 year. A few commenters believe that a maximum loan term of 1 year is too short, allowing borrowers insufficient time to pay off larger PALS 2 loans. These commenters favored a more flexible maximum loan term to establish a repayment schedule that is appropriate for the unique needs of each individual borrower. Other commenters advocated for the removal of any maximum maturity limit to allow a federal credit union the greatest amount of flexibility to establish an affordable repayment schedule. After considering these varied viewpoints, we are recommending the board finalize this aspect of the PALS 2 rule as proposed. Moving on to highlight limits on the number of loans. The current PALS rule prohibits a federal credit union from making more than 3 PALS loans in a rolling 6-month period to a single borrower. The PALS 2 proposal removed that restriction for PALS 2 loans. However, a federal credit union would not be allowed to make more than one of any type of PALS loan, whether a PALS 1 or a PALS 2 loan, to a single borrower. Many of the commenters that addressed this issue favored removing the limit on the number of PALS 2 loans a federal credit union may make to a borrower, as long as the board retained the restriction on making no more than one PALS loan to a single borrower at a time. These commenters argued that this would provide credit unions with added flexibility to meet the needs of their members, particularly those members that currently use payday loans as a source of temporary liquidity. Other commenters also favored removing the limit, but opposed retaining the limit on one loan per borrower at a time. Some commenters opposed removal of the limit on the number of PALS 2 loans a federal credit union can make to a borrower. These commenters argued that such a change would allow a federal credit union to effectively churn loans each month, charging an application fee for each PALS loan with little economic benefit to the borrower, similar to a predatory payday loan. According to these commenters, this would create a strong incentive for federal credit unions to adopt a business model that maximizes application fee revenue at the expense of the borrower, contrary to the very stated purposes of PALS loans. The commenters who argued against this aspect of the proposal have given us sufficient pause to recommend the board reconsider it. In hindsight, removing the limit on the number of PALS 2 loans a federal credit union may make to a single borrower may in fact encourage a business model that maximizes fee revenue at the expense of the borrower. This runs counter to the structural safeguards in the PALS rule, which are designed to eliminate the business practices common in the predatory payday lending space. We therefore recommend the board not adopt this aspect of the PALS 2 rule and instead adopt the PALS 1 limit of no more than 3 PALS 2 loans in a rolling 6-month period into this rule. And finally, I'll close by addressing overdraft fees. The PALS 2 proposal requested comment on prohibiting a federal credit union from charging an overdraft or NSF fee in connection with a PALS loan payment drawn against a borrower's account. Half of the commenters that responded to this question answered in the affirmative, arguing that a federal credit union could use overdraft fees in a predatory manner to extract additional revenue from a PALS loan borrower. These commenters also felt that allowing overdraft fees related to a PALS loan is contrary to providing borrowers with a meaningful pathway to mainstream financial products and services, because additional fees can have a devastating impact on the borrower's financial health and leave the borrower trapped in a cycle of debt. The remainder of the commenters that responded to this question opposed prohibiting a federal credit union from charging overdraft fees related to PALS loans. These commenters argued that the decision to extend an overdraft loan and charge overdraft fees should be a business decision for each individual credit union, and that the board should not treat overdraft or NSF fees charged in connection with a PALS loan differently from other circumstances when a borrower overdraws an account to make a loan payment. As a matter of principle, we tend to agree that the decision to extend an overdraft loan to a borrower is a business decision for each credit union to make in accordance with its own level of risk tolerance. Generally, a credit union charging a reasonable and proportional overdraft fee in connection with an overdraft advance is appropriate in most cases to compensate the credit union for providing an important source of temporary liquidity to borrowers. However, there are concerns regarding the potential harm to borrowers caused by allowing a federal credit union to charge overdraft or NSF fees in connection with a PALS 2 loan payment. Charging overdraft fees related to a PALS 2 loan payment is likely to cause substantial borrower harm. PALS 2 loan borrowers typically will be in vulnerable financial position and unable to take on additional expenses. Charging an overdraft fee in this situation will likely weaken the borrower's financial position further and can have cascading consequences, including adversely impacting their capacity to make future PALS 2 loan payments. Moreover, charging an overdraft fee in addition to requiring repayment of the overdrawn balance makes the borrower even less likely to meet other expenses or obligations. For these reasons, we recommend the board adopt a provision in the final rule to prohibit a federal credit union from charging an overdraft or NSF fee in connection with a PALS 2 loan payment drawn against a borrower's account. This includes our presentation. We thank you for your time and would be happy to answer any questions you may have.
Great. Well, thank you all for that presentation and for your dedication in bringing this important rule before the board today. I know a lot of time and effort is going into reviewing all of the substantive comments and understanding varying positions of interested parties and presenting the board with the rule before us today. I've long been an advocate for making sure we do all we can to provide consumers of all backgrounds and financial capabilities viable options to traditional payday loans. I believe it's important to point out that this PALS 2 rule and the original 2002 PALS rule by nature are not designed to be the only means by which federal credit unions can help its members escape a debt trap of payday lending. I recognize, and your comments reiterated, that many credit unions have a long history of serving their members by offering lower cost, small dollar alternates to traditional payday lenders. Credit unions do this through various member-centric offerings, such as small unsecured loans, savings clubs, and emergency loans. Yet there exists too often a segment of our population that is financially marginalized and vulnerable. Individuals who have a risk profile that prevents them from qualifying for a loan, even at a credit union. Therefore, in 2010, the Ncua created the PALS program to provide the framework to help fill this void while allowing a federal credit union to charge an interest rate to support the additional repayment risk presented by some borrowers. And since then, we've seen a noticeable increase in the number of federal credit unions offering PALS loans as an additional alternative to traditional payday loans. Today, there are just under 500 federal credit unions offering PALS loans in their membership. The latest industry call report data suggests that the industry is on pace to make more than 225,000 PALS loans this year, with an average size of around $700. Additionally, PALS loans are being made by federal credit unions across all asset classes, with the majority of the number of PALS loans being made in federal credit unions with less than $50 million in assets. This is indeed a critical point. I'm going to repeat it. The majority of the number of PALS loans being made in federal credit unions are those with less than $50 million in assets. More importantly, an analysis of the costs associated with PALs versus payday loan alternatives conducted by staff from our Office of the Chief Economist suggests that 30-day PALs loans save consumers more than $200 million from inception through the end of 2018. This is indeed making a real difference in some communities and in people's lives. With the current PALs program having a federal credit union market share of around 15%, this PALs 2 loan program is not at all intended to replace other small dollar lending programs a federal credit union may have in place. But there are more opportunities to assist more consumers in dire financial need. The PALs 2 rule builds upon the success of the previous rule. The PALs 2 rule is a free market solution that responds to the needs for small dollar lending in the marketplace. The additional flexibilities of a PALs 2 loan, such as removing the minimum loan amount, increasing the maximum loan amount up to $2,000, and waiving the requirement that a new member wait 30 days before receiving a PALs 2 loan, can serve as yet another viable option in the portfolio of financial services federal credit unions may currently offer. This allows credit unions to offer superior competing products through established financial institutions. But for this option to work as intended, it must strike the appropriate balance of flexibility and consumer protection. In offering PALs 2 loans, federal credit unions should consider how this loan will help benefit a member's financial well-being. Credit unions were founded on the idea of people helping people. So I fully expect that credit unions will offer these loans in the best interest of its members. During the public notice and comment process, tangible concerns were expressed with our proposal to not have a comparable limit like the existing PALs limit of no more than 3 loans in a rolling 6-month period. I know from many of the commenters who opposed removing this safeguard in PALs 2 and that a change could lead to repeated loans each month with little economic benefit to the borrower, similar to a predatory payday loan. This rule, however, prohibits federal credit unions from charging an overdraft fee in connection with a PALs 2 loan payment drawn against a member's account. In conclusion, reducing the numbers of unbanked and underbanked Americans will require forward-looking, thinking leadership. It will require us to really continue to do our part to embody the people helping people philosophy in the credit unions. And this rule does just that by offering another alternative to pernicious payday lenders. Thank you again, Matt, and also the rest of all of you who have worked on this rule. I do have a couple of questions now. Can you please explain why it's important that the PALs 2 maximum limit is increased to $2,000 in this rule?
Sure. So we looked at a lot of research, and research conducted by groups like Pew Charitable Trust, Center for Responsible Lending, and the average payday loan is about $300 to $400. We point out, too, though, that those loans tend to roll over several times. In fact, I think people tend to have those for a period of up to 5 months, with additional fees being added on there. We also think there's a way to help members who want to consolidate loans with not only payday lenders but auto title lenders, and those averages tend to be about 1,000. So if you look at those numbers alone, and there is no perfect answer to this, but if you look at those numbers alone, that gave our group enough consideration to think that raising it to 2,000 would be sufficient to cover larger emergency things that come up, car repairs, transmissions out, HVAC issues at home. That's what we seem to hear repeated throughout the comment letters and other credit unions we talked to. I do agree with those commenters who said we have to be careful of blurring that line once we start approaching a $4,000 or $5,000 loan, a PALs loan, or a small dollar loan. I think credit unions have a lot of options at their disposal to put members in those products that are lower cost. But for people who are truly financial distress and may not have other options, the $2,000 limit seems like a good remedy and option for them.
Great, thank you. And I also want to just highlight, or actually thank you for reaching out to a lot of the think tanks. As you know, from our first briefing, I definitely wanted to make sure that we heard from not just the commenters who wrote, but also meeting with folks from the civil rights organizations, advocacy groups. So thank you for those outreach efforts.
Sure.
What sort of alternative loans do members seek when they are unable to receive these sorts of small dollar loans?
So you've touched on an issue that is sensitive to me and our group. in looking at that, we hear about people having to reach out to church, family, friends to get these types of loans. There are a lot of people who are reluctant to do that and put that burden on them, which makes predatory payday lenders, other people unscrupulous like that, as really the only viable option for them to go to, which is why it's important not only this program itself, but other programs offered by credit unions of all charter types, state charter credit unions too, to bring them into mainstream financial services.
Great, thank you. And could you also please explain the interplay, applicability of this final PALS 2 rule with the CFPB's payday loan rule?
I'm going to defer to my counsel for that.
Okay.
It's kind of a two-pronged answer, I think. The first answer is that all PALS 2 loans can be structured so they are exempt from the CFPB rule. I don't think it's necessarily go into the subtleties of that, but the adjustments that would have to be made would be adjustments that would be beneficial to the borrowers. So the credit unions don't, if they want to offer these products, won't have to worry about the CFPB loan. The other point is that we intentionally placed or recommend that this rule be placed separately from the existing PALS 1 rule because PALS 1 has a complete exemption built into the CFPB rule, and we don't want to affect that exemption by complicating it with adding something to it.
Great, thank you. Can you discuss where you see the market for PALS 2 loans in the credit union industry?
So I think based on the analysis that our chief economist's office did, it looks like they have about 15% of the federal credit union market in this. And I don't think there is a number that is a good number or a number we should be driving to. I agree with your comments you made, Chairman Hood, about this being a viable alternative to other small dollar offerings credit unions can offer. So I think it should be a portfolio of services that a federal credit union can offer their members. In many cases, it may not be the most ideal situation for the member. There may be other products they can put them into. So again, looking at what's in the best interest of the member, are they better off with this type of product? And to that end, I would want to bring up, in the preamble, we added some language to reiterate and affirm a longstanding belief the Ncua has about underwriting. And while we don't expect a lot of underwriting to be done for these loans, we do expect the borrower's full picture to be looked at. We tended in the 2010 rule to focus on the income side of things, looking at their pay stubs and so forth. We've added language in there that really captures the true essence of the capacity to repay a loan, looking at their debt obligations, making sure that you're taking all that into account. And in some circumstances, many circumstances where the member has been a member, let's say it's a PALS 1 loan where you have to wait for 30 days, so you've got some history, you can streamline that process and have some efficiencies of scale with that. But it is important to look at all aspects of the borrower's capacity to repay.
Great, and that's a good segue into my next question. Can you please clarify NCUA's expectations regarding the $20 application fee under both PALS 1 and PALS 2 loans?
Joe would be happy to.
Thank you, Matt.
Is that back to legal counsel?
The expectation for PALS 2 is the same as the expectation for PALS 1, and that is that $20 is a ceiling, not a floor, as people have said often. Under the Truth in Lending Act, for an application fee to be exempt from the finance charge, there are two conditions. One is that it's charged to all applicants, but the second is that it be actually related to it's designed to recover the cost of processing the application. It's not supposed to be a profit center. And our expectation is that credit unions will understand who their borrowers are in these circumstances. For the smaller loans, if there is no underwriting, there is no application processing, we're going to note that the application fee should either not be there or should be commensurate with whatever the minor amount of work was involved in processing the application. And as an aside, my division develops the consumer compliance exam scope activities that are done in all the risk-focused exams during the year. And we're recommending, we did this several months ago actually, we've recommended that one of the activities be to look at all small dollar lending programs in federal credit unions that are being examined, not just the PALS programs, but the others. So we already have some concerns from reports about application fees being not in excess of the amount necessary for processing applications.
Thank you, and I have one final question, and this is regarding some of the commenters. Some of the critics of PALS 2, they come from a place of course, caring for customers. I also share that sentiment, especially as an African American who has seen the damage caused by payday lenders in a lot of the communities around the country. However, the issue here is a philosophical one in my view. My question is this: in circumstances where credit options are limited and people are desperate, do people simply not just get loans if they're out for products like this?
So I'll put my examiner hat on for a bit with this, because there are unfortunate circumstances where the risk profile of a particular borrower may not warrant them getting a loan. So I think what we've done in proposing this rule for consideration is again, hopefully reduce the opportunities where that happens. Even very strong consumer advocacy groups think there is a time when you have to tell a borrower no. Looking at everything in its totality, they're not better off with this type of loan than to give them a loan, or not, and even in not giving them a loan, you understand they may just walk down the street to a payday lender and get that there. So we want to prevent those opportunities from happening as much as possible, which is why I think the flexibility is afforded in this rule, again, added to the portfolio of sound services that federal credit unions and even state credit unions offer, can help people a lot.
Great, thank you. And again, I recognize that this is a tool that credit unions can now have as a part of their arsenal in serving their members and especially in embodying the helping people philosophy that I want them to do every day. So thank you. I have no further questions. Okay, of course. No, you're fine. He has a 12:45 flight. It's nothing I said. So he's quite all right. Safe travels.
Safe travels.
Okay, thank you. Now, Board Member Harper.
Thank you, Chairman Hood, and thank you, Matt, Joe, and Frank for your
My new counsel. Oh, thank you.
thank you for your hard work on this Payday Alternative Loans 2 final rule. I appreciate your efforts to draft a regulation to provide new options for federal credit unions to offer alternatives to payday loans. Notably, this rule includes several positive elements that underscore the statutory mission of credit unions to provide fair and affordable credit to people, their members, of modest means. For example, the final rule maintains limits on the usage of payday alternative products to 3 loans in a 6-month period and only 1 loan at a time. It also maintains restrictions on rollovers. Keeping these limits is a positive step toward helping financially distressed consumers avoid a cycle of high-cost debt. Additionally, the final rule prohibits federal credit unions from charging overdraft and non-sufficient fund fees on payday alternative loans. Importantly, the rule further extends the amount of time an alternative payday loan could be repaid to 12 months. That all being said, I also care deeply about consumer financial protection, about regulations that are right-sized, and about providing credit union members with access to fair, responsible, and sustainable loans. I also believe deeply in the core mission of credit unions to provide access to fair and affordable credit to their members, especially people of modest means. For these reasons, I must oppose the overly broad loan amounts contained within the matter before us today, and I will vote against the final rule. The new rule would significantly expand the loan limits contained in the first payday alternative loan rule of $200 to $1,000. Instead, this new rule would allow loans of all sizes up to $2,000. That is a bridge too far for me to cross. On the low end, we could see triple-digit effective annual percentage rates. For example, the resulting effective annual percentage rate for a payday alternative loan of $50 charged a $20 application fee would be 140% to 840%, depending on the term of the loan. And in my view, payday alternative loans in the range of $1,000 to $2,000 no longer look like payday loans. In fact, those loan amounts are outside the core limits of what most states allow for payday loans. Short-term payday loans with balloon payments are made in about 34 states, and most of the states cap loan sizes. For example, California limits payday loans to $300, including the fee, while Delaware caps loans at $1,000. And I believe, Matt, you noted that groups who commented on this rulemaking said that loans were typically between $300 and $400 in size. To me, a payday alternative loan in the range of $1,000 to $2,000 looks more like a personal loan, which many credit unions are already making within the 18% cap and with sound underwriting. As the National Federation of Community Development Credit Unions wrote in its comment letter, the model already exists for credit unions to meet market gaps responsibly within the current regulatory framework. The letter goes on to explain that in 2018, community development credit unions alone had nearly $2.5 billion in traditional consumer lending at under the 18% APR cap, with an average loan size of just under $2,500. Accordingly, we can conclude that credit unions are already regularly making loans at or below the proposed increased threshold. Additionally, the Arizona-based Center for Economic Integrity wrote in their comment letter that in 2017, the Arizona Community Action Association surveyed credit unions and other providers to catalog the options available to consumers who need small loans. They identified 41 credit unions, both state and federally chartered, that offered one or more loan products of $500 or less in 14 counties. These loans cost less than 18% APR, do not incur fees beyond the annual credit union membership fee, help build credit, have no prepayment penalties, are easy to apply, and do not require collateral. In some instances, no credit check is needed, and the loan includes a savings option. I know that it is addressed as a best practice in this rulemaking, but the NCUA should be doing more to encourage products that include savings options, not higher cost loans. Finally, let's take a minute to think about who the typical payday loan borrower is. The median income of a payday loan borrower is $25,000 to $30,000, and 49% of payday borrowers have a family income of less than $30,000. Additionally, the income of borrowers at storefront payday lenders was $22,476 in 2013. Also, we know over time, payday borrowers' loans often increase in size and frequency as they try to keep up with the high-cost interest payments and fees. In my view, a $2,000 loan at a 28% interest rate could push a financially stressed household into that cycle of deep, unsustainable debt. Amortized over 12 months, a household would pay more than $300 in interest and fees. If the agency moves forward with a third alternative to payday loans, my hope is that the process will be data-driven, address the ability of credit union members to repay such loans, and include savings options. At this point, however, I will vote no on the final rule that we are considering today.
Great, thank you. Board Member Waters.
Thank you, Mr. Chairman. I'll make one comment on the range of loans. You know, PALS 1 was adopted 9-10 years ago. It's been a while. And one reason we did that, at least when I read the history books here, was sort of a beta test to understand the market. And the original PALS 1 were loans between $200 and $1,000. What I'm told that we learned is that, you know, there really are people with payday credit that need a $50 loan. And there's really people around with payday lender credit risk that need a $1,500 loan. Also note that in a comment letter from Mpcu Charitable Trust, and I think Mpcu stands by itself as a champion of consumer rights. So this is hardly a pro-payday organization. They said, you know, you really should consider going to $4,000 because people in the payday risk category need to borrow more than $1,000. They actually need to borrow more than $2,000. So we sort of split the difference again, sort of as a beta test on PALS 2. Also, if you just look at inflation over the last 9 years, PALS 1 started at $1,000. Just inflation alone, I haven't done the numbers, but I would guess it takes it to $1,300, $1,250, something like that. And so if we don't increase it at least somewhat, then we're falling behind what we had in PALS 1, which I think is definitely moving in the wrong direction. Also, I recall that a few years ago someone won I think a Nobel Prize, maybe in economics or peace, I'm not sure, for something called microcredit. And it was the idea that people in Bangladesh, for example, need $50. And $50 can change their lives. And I'm sure that there were some Americans who thought, yeah, $50, not in America. Well, bad news, folks, is there are really people in America that need $50 just as bad as the folks do in Bangladesh. So I would hate to send someone away from a federally insured credit union with strong history of consumer protection, with a strong history of financial literacy within the credit union, send them away to, let's say, a payday lender because they fall below an arbitrary amount. And this may be an overstatement, but I would hate to think you can get microcredit of $50 in Bangladesh, but not in the U.S. I understand the numbers Mr. Harper mentioned. The APR is high, but I'm also a realist. I'm a deal lawyer. I'm trying to figure out a way out of this jam, and I think that's the best way.
And may I just make a quick point? I do appreciate our efforts over the last few days to try and find common ground on this issue, and I do feel that you were reaching out, so thank you.
Oh, you're welcome. Well, try, Todd, and I appreciate you back and forth very much. And that's what we should be doing here. Okay. The bottom line, though, what I'm most concerned about, if you're the person that needs the $50, you need the $1,500. This is not theoretical to you. You really need the $50. You really need the $1,500, and you're going to get it, okay? Because you have to get it, okay? There's no choice here. We can't get too ivory tower about this. So what do you do? In that you maybe go to the payday lender. But the truth of the matter is maybe you go to another credit union product, right? The one that credit unions offer. Because credit unions, whether they know it or not, are payday lenders. And they are, well, I should put it this, that they're small dollar lenders, right? They do it all the time. Almost all credit unions are small dollar lenders. They may not call it small dollar loans, but it's overdraft protection, right? It's credit cards, subprime credit cards. Who hasn't at some point in their life said, hey, a little bit low on the checking account, so I tell you what, I'm going to charge this one. I'm going to let this ride. I'm going to pay some really, really high interest rate on my credit card, but that's just the way it is because I'm short of cash. That's reality. Who hasn't at one point in their life said, I owe $800. I gotta write this check now, but it's not going to clear, so I'm going to let it ride on an overdraft of $30. I'm going to pay a $30 fee to have really, in effect, an $800 loan, okay? So I don't like the idea of driving people into overdraft protection. You ever run the APR on overdraft? I did that yesterday, back of the envelope. If I was really great at math, I'd probably be a physicist right now. So you can't quote me on these numbers, but I said, what if someone has $20 check that they can't cover, and they get a $30 fee, and the fees has to be paid within 7 days, and the APR was around 7,000%, 7,000, not 700, not 70, but 7,000%, and that struck me as being confiscatory. Not a great option. It's as high as the numbers are that Mr. Harper mentioned, I would not rather be in there if I'm a consumer than at 7,000%. Over the last few years, I've been very interested in this issue. And I've traveled around the country and I've talked to people, and I've had disparate views on this issue about small dollar lending. Because the first thing is, what is small dollar lending? Small dollar lending is cash flow management for people who don't have enough cash. That's all it is. Small dollar lending sounds rarefied and fancy. It's like we're doing something that's different. No, these are people that need to manage their cash because they don't have enough of it. If you have a lot of cash, you can kind of not manage that great, okay? But if you're low, you're in trouble. So I met with credit unions, and they said, hey, Mark, we underwrite our small dollar loans, and 18% is enough. If your borrowers have the ability to repay, 18% is enough. So, Mark, we don't need your PALS 1. we don't need your PALs too. In fact, we think they're sort of antithetical to the whole credit union movement. Okay, I respect that. I've gone to other credit unions and they've said, we just can't make it happen. Maybe some people can make it happen. With our affiliate membership, we can't make it happen. So we do use PALS 1. We need a 28%. We need a higher fee. Okay, then I go to other sets of credit unions and they say, 18% is not enough. 28% under PALS 1 is not enough. Your PALS 2 proposal is not enough. We need a risk-adjusted rate of return, and that's higher. That's higher. So we simply don't do this. So those credit unions, in effect, push people into overdraft and credit card. And then you have the fourth group that say, small dollar, well, we don't even think about that. I understand that. I respect all that. So the question is, what do we do now? What do we do now? Well, if PALS 2 answered everything, addressed all the questions, answered everything perfectly, tied a little bow around it, we would be done. But we're not done, right? Because PALS 2 really doesn't solve the problem. It helps a lot, I think. I think PALS 1 helped a lot, but it doesn't solve the problem. So the first thing, we need to figure out what the problem is. And again, as I said before, I think it's management of cash flow for people who don't have enough money. And have maybe a meeting or a discussion or debate among members of the credit union community as to the best approach for this small dollar lending. Let all the voices be heard, let people debate, because I've identified 4 different groups and they have 4 different opinions and they're strongly held and they're backed by their empirical data. So let's debate it. The community comes up with something, and then they come to us and say, hey, we need some regulatory movement on this in PALS 3 to accomplish this. It will solve it. It will protect consumers, but it will permit people who are low on cash to manage their cash in an efficient way. I would be all for that. Mr. Chairman, those are all my comments. Thank you.
Great, thank you. And thank you for acknowledging Muhammad Yunus, who was the gentleman that he was referencing in Bangladesh as one of the pioneers of the microfinance movement. With that being said, though, is there a motion?
Oh, I think it's my turn. Okay. You always want to make sure you're reading the right motion. I move that the board approve final rule part 701 of NCUA's rules and regulations as attached to the board action memorandum.
Thank you. Is there a second to the motion? Hearing none, I second the motion. All in favor say aye.
Aye.
All opposed say nay.
Nay.
The ayes have it, and let the record show the motion passed 2-1. Thank you, gentlemen. Today's board action is a critical step forward in giving credit unions another tool in solving for unbanked and underbanked households. It also gives these Americans the opportunity to enter the financial mainstream for providing an opportunity to build credit and ultimately for the ability to qualify for traditional financial products outside of the PALS 1 or 2, but it gives them an opportunity to really participate in the economic mainstream. I want to thank you all for joining us today as I bring this board meeting to an end, there being no other business, so we are adjourned.